Hi there, welcome back to Archetype Financial, two guys talking money, take two. I'm here with Greg and my name is Boyd. Say hi.
Hello.
We're still trying to shake the rust off of this process a little bit and get a little bit more comfortable with it. In our first episode, we talked a little bit about some of the questions that our investor clients have put to us over the years. And we're going to, in that vein, continue. So, Greg, one of the questions on here is, I'm thinking about my investment holdings and wondering what to do with them at this point. Are the markets safe to invest in?
There's always going to be different approaches on that. Right now, you got different advisors saying different things, and some of them are more oriented toward what's best for clients, and some of them are more oriented towards what's best for the advisor. Keep in mind, your advisor leaves you in a heavy equity mix if your advisor does that. When markets are very much into record territory, they may be leaving you in a dangerous position. Markets, don't forget, almost always fall from the top.
Almost always?
Almost. Occasionally, they will fall from the middle.
Oh.
Very occasionally.
Okay.
But almost always, they will get to a top and then fall. Problem is, we don't know where that top is. So as well, with the trade issues, with the markets being in record territory right now, like well into record territory.
And for the record, we're in the end of fiscal year 2025 right now.
Right. And with the trade issues and et cetera that are coming from the US, a correction really could happen anytime. All we got to do is wait for somebody in Washington to say or do the wrong thing.
Nobody in particular.
Yeah.
Yeah. Okay.
Or we'll reward you 3 cents if you can figure out who.
Okay.
Also remember
Let's not make this a political conversation.
Also remember the archetype will typically move you into a safer position when markets are at a high point. That leaves you with less risk of loss when markets do fall, as well as much more ability to buy in later on at a heavily discounted price after the markets have dropped. You pay less to get in. Also, the markets will already drop, so you get in with less risk.
And what happens after the markets drop?
After the markets drop, we wait until, again, not the bottom, because neither us nor anybody else knows where the bottom is. We wait till the markets go down low enough until the discount is frankly too attractive to miss. For example, if the markets drop 20%, we might start suggesting that you buy back in. If the markets go down a total of 30% and you bought in at 20, you're only down 10, so it's not terrible. And a typical recovery is 15 to 25. So your recovery is pretty generous in terms of taking care of the loss. It does sound like market timing. It's not. We simply decide when things are high enough to take profits, and we walk away from equities with your profits intact, protected. Then we buy back into equities when we see an attractive discount position. And I start looking at about minus 15 and about minus 20. I will typically say, let's buy.
Mm-hmm.
But that will be up to the client, and it will be up to the client to decide on their own comfort level with this.
So can I stop you there and just reinforce a couple of points?
Yeah.
What you're suggesting is that when the markets are at or high and we're expecting the markets to start down a decline, right? Like currently we're in a record market at the present time. We'll shift our client portfolios a little bit away from equities.
Or a lot.
Depending on a number of factors, depending on the client's particular tolerance to risk and investment objectives, and maybe their age. And we'll move them out of equities into cash or cash equivalents. And then when the market has declined 15 to 20%, we'll start to proportion their portfolio back towards equities at the reduced prices.
Yeah.
So that we can take advantage of the recovery.
That's right. So the issue is at the top, at the bottom, where are those points? Nobody knows.
Yeah.
We don't know where those points are. The only way to capitalize them is to be prepared. So at the top, you have to say, I've made enough money and the markets are getting higher and higher. And as they get higher and higher, the risk of a correction gets higher and higher. So I'm going to move out. I'm going to go into money market, which is cash, or bonds, and I'm going to stay there until we get a correction. And then when the correction happens and risk gets reduced, I'm going to buy back in.
So you're buying those equities back at a price point that's more affordable.
Yeah.
And more advantageous for you, the investor.
And the risk of loss is behind you instead of in front of you. So
right.
It's a much lower risk. It could still go down a little bit, but most of the risk is behind you. That's a good time to buy in.
This sounds pretty Buffett-esque.
Yeah, it is very Buffett-esque. And that's one of the places there's Warren Buffett and a couple of others, including an old mutual fund guy that I used to follow very heavily. He's since retired. But they all did the same thing. Another point in this that I would like to stress, because it's important even though clients aren't often aware of it, Archetype takes a fairly big hit ourselves to do this for clients. The trailer fee is what we get paid from your investments on an annual basis. They send bits of it monthly, but it's an annual fee that we get paid. When we switch you over to bonds, the amount that's in your bond holdings only pays us about 50% of what we normally get for balanced funds or equity funds. So we take a fairly big financial hit to do this for our clients, and we do it because we think it's better, it's safer, and you make more money in the long term. The buy and hold argument that many advisors use is okay if you can wait out the correction, which might be 2, 3, 4 years, but it's still paying the advisor the full trailer fee.
So we're essentially, by providing this service to our clients, we're reducing our own income potential.
Right.
And putting our clients' needs ahead of our own.
That's right. So do you want to pay full price for somebody else to do nothing and say buy and hold? Mm-hmm. Or do you want to pay us 50% less for protecting your profits and enabling you to move forward with more money and make more profits in the future?
I like that idea.
In the long run, clients seem to as well.
Well, and I actually jotted something down here, and I wondered if this can't be one of Archetype's mottos at some point. We're here to grow and preserve your wealth and savings.
That's right.
And that's Archetype Financial.
That's right. So our general focus is, from my perspective, there is 3 points. Mm-hmm. We want to grow your investments. We want to protect the growth that you earn, and we want to be able to get it back to you in as tax efficient manner as possible.
Excellent.
It takes a fair bit of planning to do that, but we have a lot of experience in doing that.
Well, that's probably a good place to leave it here for now. So again, I'm Boyd.
I'm Greg, and thank you very much for listening.
Thanks.